And again, our abbreviations you might run across as we look at AET, Asset Equity Table. This is going to be how the IRS refers to it quite often as we're working with them. So what is the RCP? What does reasonable collection potential mean? That's plain and simple. Basically, what can they get out of you? It's the value of the equity in your personal assets. It's your personal monthly income. It's your business assets and your business monthly income. Now, we're also going to argue things too that we'll talk about, like your business assets. You can have some exemptions on that to say, well, you can't count my assets and basically, in essence, take those away and also count my business income because I need those assets to earn the income, so that you can't really take those twice from me. So there are some exemptions in that case because you say, well, it's for production of income. I need these assets to produce that income. So we'll get into a bit more of that detail, but it's everything they can get out of you. That becomes our bottom line, that reasonable collection potential that ultimately becomes your offer number. So what our procedure is that we list all assets except exempt items, and it doesn't hurt when you're filling this information out to say why they're exempt or what amount is exempt if you want to notate that, because it just makes it that much easier for the person that's trying to go through and work this offer on the IRS side. You need to determine the fair market value of each. Now, this is definitely where we're going to spend some time saying, how do we figure out the fair market value? Because we as accountants should not be assigning a value to anything. We find ways to corroborate that. We find ways to determine that value, but we are not the one that is creating this value or pulling it out from somewhere in the air. This has to be something with documentation. We multiply it by a quick sale value. So what is quick sale value? It is the idea that if you had to quickly liquidate this asset, they're not going to get 100% of its fair market value. They would usually only get, and they use a factor of 80% of the quick sale value. You're going to subtract any debt on the asset and subtract current taxes, and that's only if it's caused by liquidation. And the result becomes the reasonable collection potential of all the assets or that equity component. So let's talk about personal assets and exempt personal assets. There are amounts that are automatically exempted, and you need to know, and I've referenced in here the 5857, because if you want to notate this on your offer and compromise form, it's helpful to know where it comes from. Cash is exempt up to $1,000. So you go through and you figure out your cash. Here's my cash and my checking account and my savings account, what have you. And by the way, cash doesn't mean all just necessarily cash in your pocket. It's all those liquid, checking, savings, cash, etc. Up to $1,000 is automatically exempt. So what does that mean? So they also get to subtract additional cash needed for basic living expenses. So we're going to go through an example because, as accountants, we love numbers. It makes things easier. If the taxpayer says $10,000 is the total cash they have in cash and savings and checking, and their living expenses per month, allowable living expenses, is $3,000. The IRS, right within that IRM, is instructed to list $6,000 as available cash. Where did I get $6,000 from? It's the $10,000 they had minus the $1,000 exemption minus $3,000 for 1 month's worth of living expenses. In that example, they would only use $6,000. So what you're going to do is notate that on your offer and compromise form. This taxpayer has to use their cash in order to pay for their allowable monthly living expenses. Another hint for you here is how you figure out what is that cash balance from the checking. What is the cash balance from the savings? How do you determine that? I will use the average low balance. Why average low balance? Why don't you just take and grab that balance on the last day of the month on that statement date? Because maybe our taxpayer has paychecks or something drop in on that last day of the month, and they then take all that money and use all of it to pay for their living expenses. What I do instead is I determine, well, after they've paid all their living expenses, that low balance, whatever they're left with at that given month, is really more realistic of what their balance is. And you have to provide them more than 1 month, so they go back a minimum of 3, or if you have a good, compelling case, you can give them more. Let's say you're going to give them 6 months or even a year's worth because something in there is very compelling. When you average it out, here's my checking balance. Here's my savings balance. So all that together, if our $10,000 balance taxpayer, we're going to indicate, okay, minus $3,000 because that's their monthly living expenses, minus $1,000 of the automatic exemption. $6,000 is what goes on my calculation for the cash balance on my asset side. Then we also consider vehicle equity. Vehicle equity, 5.8.5.12. I love all the subsections and the subsections. Vehicle equity has an exemption as well. $3,450 after the quick sale value has been applied for each vehicle. So you would go through, you'd figure out your fair market value, you'd apply the 80% quick sale value, you'd subtract any debt, loans, auto loans on that, come up with a value. And then let's say that whole vehicle equity is only $4,000. Then we go through and subtract that exemption. So $4,000 minus $3,450, well, your vehicle equity left over is not that big of a number anymore. That becomes the real number that you're going to put on that. And we're talking all in these cases about the 433A OIC. That's your worksheet, your financial worksheet for assets. And that's because it's for each vehicle. The best thing to do is lots of notes. You don't want them to have to try to read your mind, and you want them to understand your client's situation as well as you do. You're the representative standing in their shoes. That's the idea of representative. You know them so well, you can stand in their place. You want to make them understand your client as well as you do. So make notes and help them to understand your math. You also have the ability to exempt income-producing assets, and that's under 58515. Income-producing assets are exempt if you're already counting the income produced from the asset. As we mentioned, they can't really fairly count both. However, watch out. They do offer further guidance in 58515 for income-producing assets. So this is just kind of pointing you to where you can go for further guidance, but let's say that their sole business is real estate, rental, or leasing and development. So if you're preparing an offer for a taxpayer with a business, even an S-corp business, it provides this guidance in sections that you're going, okay, can I exempt this asset? Can I exempt the income? Because they're going to look for things like, well, okay, so what if this business is a factory and all this factory equipment, it would be just so difficult to try to resell it. The IRS may not be all that excited about counting the factory equipment, but maybe it has this huge value and the income producing amount of it's very tiny. They may say, oh, we don't care about the income. We'd rather count the asset. So that's kind of a little bit more as to what that guidance talks about, and as well as the rental or real estate aspect, then you can say, well, do we count the equity from the home or the rental, or do we count the income from the rental? So you can't count both, but it's going to give you a lot of further guidance in there as to where you can start reading into, do I count the asset? Do I count the income? How do I notate it? In all these, I really highly recommend that you, in that circumstance specifically, you reference that and say, according to this IRM 58515, this is what it says about not counting both the income and the asset. This is how I determined it. The more you reference that, that's their playbook, and they're going to go, yeah, we have to do what that playbook says, basically. So that could be motor vehicles, equipment, rental property, a little bit of everything there. At this point in time in 2016 and in 2017, we have to wait. They come up with exempt. They have to do inflation calculations each year is what happens. So we have exempt furniture and personal assets. So back in 2016, that number was $9,120. And I get asked, where do you come up with that $9,120? It is the exempt amount, the inflation-adjusted exempt amount of $11,400 times that quick sale value of 80%. So that is, after that calculation, if your furniture and personal effects are worth $11,400, there's going to be nothing there that you have to count in that offer. Secondly, in 2017, that becomes $11,500 so it kind of a little tiny jump up in inflation adjustment, times your quick sale value of 80%, so it's $9,200. The only one I don't have yet is 2018, which, by the way, they'll be releasing pretty soon. In your supplemental guide, it shows you that calculation, and just kind of watch in the news wires if you're interested in what 2018 is. Exempt tools of the trade also has a very specific inflation-adjusted amount. So automatic exemptions, these say if they are not over that amount, it doesn't count in there. And this has to do with levy exemption amounts they can't take if it's under this amount. So for 2016, that amount is $4,560. Again, similar way that's calculated. And in 2017, it bumped up a little bit, not a giant amount, but $4,600. So that's where we get that information from. So if we know that amount is exempt, we get to kind of subtract it right at the top. Like, hey, that's exempt. Here's the only value that we're really adding into that offer. For valuing assets, this is what we talked about. That fair market value is so important. Don't ever go and assess the value ever for your clients. You have to be impartial. You have to be that representative, but kind of the intermediary, the in-between person, and you don't want to be the one valuing things for your client. Now, you also have to worry about proper allocation. Is this a joint asset? Is it 100% owned, 50% owned? Because let's just say a joint owned real estate, and it's between a taxpayer and their brother. Well, you have to figure the proper value, the proper encumbrances, loans, whatever. But then you would go and say, but they only own 50%, therefore 50% of this asset equity amount is theirs. So pay attention to what percentage of ownership they have. And there is a very specific document in there about jointly held assets within the IRM. So you'll find that within 5855 of the IRM. But it gives consideration in there for state law, because we have to then start worrying about community property and registered domestic partnerships. And so there's a lot of muddy things that can muddy the waters a little bit. But it's not just as simple as that percentage that I said of ownership. If it's, let's say the tax is owned entirely by one spouse. Now here's the situation: if they truly, each spouse owns that house or asset item 50%, usually the taxpayer only has rights to 50% of what they, again, abbreviations, NRE, you'll see in the text, net realizable equity when you're looking in the IRM. So the taxpayer only owns 50% of that equity, but they owe 100% of the tax. It's going to limit what the IRS would have as far as rights to take from them. It also gives a little more guidance for joint owners, both having joint and individual liability. Now, this is the case, maybe a taxpayer and a spouse both owe the tax. Then it gives a little more guidance how they count that. So they normally allocate first to the joint liability, and then whatever's remaining to the individual liability. So there's a little more direction. Don't worry too much about memorizing all this that I'm telling you. The best thing is to know where to find this within the IRM if you need more information. And you have to worry about things like divorce decrees, separation agreements, and how do we show dissipation of those assets in those settlements? So they're going to wonder, well, you had this, just a couple years ago. What happened to this asset? You can also look at additional documentation like homeowner or renter's insurance policy and riders. They're going to use that as a way to determine maybe what that asset could be worth. Maybe the homeowner's policy is insuring it for X amount. That could be a good indicator of its value. You might want to also pay attention to that because they can identify a high-value personal item. If they have a rider on there for a jewelry insurance policy, you might have some valuable jewelry that the taxpayer has, or maybe artwork, antiques, something going on. It's going to give you an indication that that's out there. You want to try to worry about how to value the business assets and inventory as well, which we'll talk a little bit of that. So there's a lot when we consider this is not as simple on the surface as it may appear, or that some folks make it sound.